Most incorporated business owners spend years trying to figure out what the best way to pay themselves is. Once they figured out that problem, however, they tend to make an even larger mistake, and that's leaving hundreds of thousands of dollars sitting inside their corporation with no real plan. That's not just idle cash, that becomes idle opportunity. And there's even one more layer to this that catches even more owners off guard, and that's the tax treatment on passive income. Passive income is income that's earned inside your corporation that didn't come from the day-to-day activities of your active business. So active versus passive. Passive is taxed at the highest corporate tax rate, which is around 51%. And if it's above a certain threshold on a yearly basis, it can actually grind down your small business deduction, which is the preferential tax treatment that you received originally inside your corporation. And if you watched episode 1, salary versus dividends, you know that the blend, salary plus dividends plus a deferral, is in most times the best way to pay yourselves. So at the end of the day, you will have deferred money inside your corporation. But today we're going to answer the question, what do you do with that money when it sits inside the corp? My name is Evan Jones. I'm a chartered professional accountant. I'm a chartered investment manager, and I work with incorporated business owners across Canada on integrated wealth planning, not tax preparation. Quick note before we get into the video, everything that you see here is general purpose information. It is not specific financial planning advice. Your situation is obviously going to be different, so you should consult with your CPA or your advisor on your individual situation. We've already established that the blend, salary, dividends, plus corporate deferral, is the optimal strategy in most situations. Now the question becomes, what comes next? So if we pick up from our previous video, salary versus dividends, and we'll look at or revisit Sarah's situation. If you remember, Sarah had $300,000 of active business income through her corporation. She also needed $120,000 of personal after-tax income to spend from a lifestyle capacity. And so what we recommended in that situation was salary up to the YMPE, dividend out the remainder to get the $120,000. That ended up with an approximate amount of $80,000 tax to be paid between the corporation and herself personally. And that also left $100,000 of retained earnings inside the corporation. That's on a 1-year basis. So if we extend that out multiple years, say 3 years, that's a $300,000 buildup of retained earnings, and that becomes quite significant. So up to this point, Sarah has done everything right, but this is just the beginning. The deferral advantage. I want to be very clear here because this is extremely significant, and you need to understand really what's happened in Sarah's situation. Every year that she follows that blend and defers $100,000 inside of her corporation versus paying it out as a dividend or a salary makes a significant difference in the starting after-tax dollars that she has the ability to use to invest, grow her business, or create wealth. So the deferral advantage is $100,000 sitting in the corporation, or if she kicked that out to herself personally and paid personal tax at the highest marginal rate, she would be left with $58,000. And if we take that out in that 3-year example, that $42,000 every year is a $126,000 difference in terms of that starting point. Now, tax deferral is not wealth creation. It is the starting point. If you don't make the right decisions after that, it negates a lot of the benefits. A head start only matters if you use it. And what I mean by that is there's a certain amount of opportunity cost by leaving money sit idle in your corporation. I want to put some numbers behind that. So let's assume Sarah needs $50,000 operationally to run her business. So that money has to be short-term, it has to be accessible and liquid, so we're going to ignore that. But the remaining $250,000 can be used to be a little bit more long-term planning or have a goal with those dollars. So we got 2 scenarios. One is you can leave money sitting inside the bank account, the checking account, put in a GIC or another interest-bearing account earning approximately 2%, or you can have it in a more diversified portfolio of stocks, bonds, ETFs, more long-term in nature and earning a higher rate of return of approximately 7%. Now, compounding growth is a very powerful foundation, and I won't get into that because most of you probably already know that. But if we look at the example over 10 years, the GIC or interest-bearing account is going to grow to approximately $305,000, and the diversified portfolio is going to grow to $492,000. So that's a difference of $187,000 more wealth created by taking a longer term approach. Now, the other thing that I'm not going to get into here specifically is these are pre-tax dollars. Investment income inside your corporation is taxed differently depending whether it's interest, dividends, or capital gains. Interest income is the most punitive form of taxation that you can earn. So not only does it have very low rates of return, but it has the highest amount of tax associated with it. So if you take nothing else from this video but this, it's to understand how inefficient interest income is inside of your corporation. So as always, the key theme is to have a plan. Before leaving corporate cash where it sits idle in the corporation, you should be asking yourself 3 questions. Number 1, have you maximized your tax favorable accounts personally? Being that you're using the blend, you're creating RSP room, so are you using it? That's actually what we're going to cover in the next episode, so stay tuned for that. And do you have a plan for those corporate dollars that are sitting in the company, or is it just sitting idle in cash? Are you planning to invest back into the business, hire more staff, invest in a building, or is it going to be an investment for the long term? Because idle money sitting in the corporation in cash is not benefiting by the deferral or protected by it. It's an opportunity cost, as we talked about. And do you know how much passive income that the corporation or associated corporations are actually earning on a year-to-year basis? That $50,000 threshold is real, and most owners aren't even tracking it. So once you've asked yourself those 3 questions and you've determined an appropriate answer to them all, the next step is to give every dollar a job, or every corporate dollar a job. And we want to effectively think about it as a bucket strategy. So there's 3 buckets here on screen that you can see. The first bucket that we want to fill is that operating reserve. So that is 3 to 6 months of overhead expenses that you need to be able to cover within the business, and that's a non-negotiable. So that should be in a bank account, a high interest account, very accessible, very liquid, because that is what you need on a day-to-day to run your business. The next bucket that we want to structure is the capital with a purpose. So these are dollars that aren't necessarily needed on the day-to-day for the business, but we want to make efficient use of that capital. And to be honest, this is the one that I probably struggle with personally the most, because when you're running a company, as you know, if you have staff, if you have overhead, right, there's some risk there. You need to have cash flow to be able to cover those things, and it's really quite comforting from a behavioral finance standpoint to open the bank account and see cash. Long-term planning, it is not efficient, but I also understand why people want to do that. So I even have to make myself change my framework of thinking to deal with that as well. The third bucket is the one that we want to avoid entirely, and that's the capital without a purpose. So here's where we landed. Blending your income with a corporate deferral puts you in a far better starting point than paying everything out to yourself personally, but having a head start only matters if you use it. Retained cash without a plan is not a strategy. Before you leave it where it is, ask yourself 3 questions. Number 1, have I maximized my tax deferred accounts? Number 2, do my corporate dollars have a plan? And number 3, do I understand the amount of passive tax my corporation or associated corporations are earning? Once you've answered those 3 questions, then setting up the bucket strategy is the next step. An operating reserve bucket and a capital with a plan bucket. Nothing sits idle. And at the end of the day, have a plan and give every dollar a job. If you're an incorporated business owner and would like to go deeper into this topic, my contact information is below, and I'd be happy to have a conversation.